You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, and a good morning to you.
The excited states not as excited as before.
Well, I don't follow as intensely as other researchers the economic numbers. That's for economists. But lately, the last 4 weeks, they've not been in the U.S. as good as was expected. For example, you had a consumer sentiment number last month that was outstanding, like to the moon, and then the following month, February, not as good. So our theory on this one is that when you're in a world of financial manias, the link between the stock market and the business cycle changes. More traditionally, you'd have a peak in the stock market, and then maybe 10 or 12 months later, you'd have a peak in the economy. And this was always amusing because you'd have many investors staying in the stock market because the economy was good, but the economy was bad, but the stock market was bad. And then they'd figure it out about 10, 12 months later when the economy did start to weaken, so they then would be selling in the middle part. And then, of course, the bottom part in the old days was you'd have the stock market bottoming and turning up and leading the business cycle. So then you would have stock market up against bad economic news. So then those who traded stocks off the economy would be then getting out at the bottom. So it was always interesting, that behavior pattern. But since, and it happened in previous bubbles, like where you've got good data back to 1873 in the U.S., the moment the bubble ends, it's more or less the business cycle ends as well. 1873, the stock market peaked and headed south in September, and as the NBER determined it, the business cycle headed south beginning October. Then in 1929, the stock market peaked in the U.S. in September, and the economy peaked that August. Then moving forward to the next great bubble, which was 2007, the stock market peaked in the latter part of October, and the business cycle peaked in December. So, and again, at the bottom, in 2009, the panic ended in March, and the business recovery was determined to have begun in June. So here we are now, perhaps, and I've looked for this before, perhaps we are getting close to the end of the business expansion and close to the end of the great bull market in stocks. So we're watching for change. That's the key thing. And in the stock market, change would be indicated by the advanced decline ratio turning down, and we're using the advanced decline ratio of the S&P 500. Not yet. The negative against stock market on the financial side is that credit spreads generally have been widening since June. The last 4 or 5 weeks they've had a very good correction in that trend, so it's been looking good. Then the other one is the yield curve, the difference between the interest rates at the long end of the bond market and short rates, and it's still flattening, which sort of occurs during business expansion. So there's a number of pluses and there's a number of cautions out there. And so one of them actually is the old Dow theory. And our question in yesterday's piece was, how will modern portfolio theory handle the old Dow Jones theory? And the Dow theory is that at a peak, the Dow will set a high, and the railroads, as it used to be, now transports, don't set the equivalent high. So in this time around, the high, where the last high for both of them together was December 29th. So we've been watching this one for a couple of months. Is that then you have what's called a non-confirmation, where then you have yet another high for the Dow, but the transports don't make it. So that now, where it becomes interesting is if the non-confirmation occurs within 6 weeks, you can have a modest correction. And if the non-confirmation period stretches out, and this is the 8th week, you can have a larger correction in it. So this is an old model, but perhaps it's a goodie. So we're watching for any change there. And it's, again, if we are getting an important change in here, and the reason why we are alert to change is because sentiment and momentum numbers, sort of from the summer on, were found only at cyclical peaks for bull markets. So you are in a precarious condition, and we do recognize that governments through their central banks have been intervening in a manner unseen ever. So you have currently the bid for the European bonds, and you also have in the U.S. the plunge protection team who from time to time will buy the stock market. And there was a woman a couple of weeks ago published a piece. She was formerly on that plunge protection team. They have a more polite name for it, but I can't remember what it is. But she says that there's very little room or very little going on in any price series that's not influenced greatly by government interest. And this is interesting philosophically, because you'll have somebody in a committee at the Fed or the Treasury or some advisory agency, and they take a look at business conditions and they say, oh, it should be better. Well, what particularly godlike abilities do they have to determine that it should be better? So this is purely arbitrary notions. And then they have these other arbitrary notions that if a certain arbitrary move is done in interest rates and that sort of stuff, then you'll get the result of this arbitrary decision that it should be better. Well, they've been doing this for 100 years. And it's created a very distorted financial market where you can have a bubble just, in an instant. And then, of course, they get out and say that there is no bubble. But we have had a very buoyant market for U.S. junk bonds. That was right up till June when we had technical overboughts on that. And you had a very good correction in those down to when junk bonds were getting hit very hard as crude was crashing. There have been a lot of issues. I think about 18% of junk bond issues done in the States were related to oil companies. And that then, the junk bond became extremely oversold. We noted that it had a pattern which we called a springboard buy. So that it's bounced here, this is junk, and to last week, where it gave the opposite signal on the rebound, a springboard sell on a daily. Now, this week we've got that springboard sell has come in on the weekly numbers, and even more important, there's an upside exhaustion, which is a different model on the price advance on the daily, and that is only 7 times we've had one of those since the J&K has been trading. I think that's since 2007, and each was followed by a significant setback in the price of junk. So this is poised, ready to reverse. Now, where this comes in is that we use the spread from high-grade bonds to junk to determine credit spreads, and so these are now overbought. So the correction in widening credit spreads is probably pretty close to ending, and widening spreads is not very comfortable. So that's a negative for the stock market. Then a month ago, we had the upside exhaustions and that sort of stuff on the long treasury, the long government bond, and it sold off 8 points and has bounced back, recovered about 4 of those points, and seems ready to continue the decline. Rising interest rates in this market won't be very good, but we're wondering what the action in the U.S. Treasury, how it will relate to the price action in European bonds, which really are in no man's land. I looked at the German 10-year note here just a little while ago, and a couple of days ago it was down to 0.30%. It should be trading maybe around 3%, but 0.30. It is amazing. Then various others. So you've in Europe you've had now yields rose hugely on the Russian problems and have been blessed since the crude oil stopped going down in January. Then you've had the Greek problems, and I don't think that these things are isolated. If you look at the history of distress in foreign bond markets way back, once you start a problem going, it usually goes to a convulsion. And so the idea that maybe Greek can be fixed is impractical, and it's heading the wrong way. Also, I think that the whole creation of a European community, the part of it was attractive was to ease trade and people crossing borders. That was great. But what they should have done is just open it up. Everybody declare free trade. But they ended up with a very managed freer trade run by a bunch of bureaucrats in Brussels, and it's a monster. And even the apparatus of that government can't be afforded. So anyways, when Greece or Russia or whatever, well, Greece is the key. It can leave, which would be a good thing. But that may be the start of things. So that's getting us to a considerable mounting risk in interest rates. And the central bankers really, as we've been using the term, have a tiger by the tail. They just cannot let go, otherwise they're going to get clawed to death. And the longer they keep pushing buying bonds and all that sort of stuff, the more precarious the condition becomes. And we've got technical change going on in lower grade bonds in the U.S. and the high grade. So how Europe can be isolated from that, we don't know. So
we'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Bob, back in 1980, a certain person said, "We have wrestled inflation to the ground. You don't have to worry about this sucker anymore." Maybe explain that to us.
Oh, yeah, that was chairman of the Fed, Paul Volcker. And this is one of the great ironies in the game of economics, is that the 1970s was the greatest run-up in commodities, producer prices, and wholesale prices since the 19-teens. And then that one, you had commodities soaring hugely. Right? And let's keep in mind that commodities are always traded globally. So the commodities soared up in 1920 and then crashed real hard. So then the boys at the Fed, which was a new tool, took a look at that, and the hit to commodities just scared the hell out of them. So the early 20s and into the mid-20s, the Fed was deliberately easy with credit, with the notion that they didn't want commodity prices to fall. So then they kept easing, and of course what happened is the public decided, hey, we're going to go speculate in stocks, which they did too. But the Fed, of course, was looking at commodities when the speculation was in financial assets, and then you ended up with a true blue bubble that blew out in 1929. So here you are. These great speculations have similarities no matter what century you're in. So then you come along, in the 70s was another great, fabulous speculation in commodities, which are priced globally and trade all around the world. So what happened? They reached a climax. Everybody was in, and then commodities crashed in 81 very hard into 82. So here you are. Volcker was chairman then, and so they said it was due to his policies. But if you take a look at U.S. money supply figures through, late 70s, early 80s, there was no change in it kept growing. It kept growing. But here's the other point. because it was a global boom in commodities, it was a global crash in commodities. So anyways, that then, guess what, set up the next era of financial asset inflation. And so that was when I was first starting to present the research to financial institutions, and that was really in 81. And the pitch was, or the final conclusion was that no matter how much the Fed printed, that stocks would outperform commodities. Well, that point, about 1980, is when many financial institutions were just discovering that inflation was caused by the Fed. Prior to that, they were kind of naive, and they listened to the economists about it. But at any rate, that was a highly controversial notion in 81 and 82, that stocks would outperform commodities and that the Fed would still be reckless in expanding money supply. And that's continued here. Look, you've had a serious bear market in commodities, most commodities, since 2011. And it's really since 2011 that the central bankers have all gone crazy and flooding the money markets. But here's the disconnect between policymakers and the markets, is that the public chooses what's going to be speculated in, and what's been speculated in is stocks and bonds, not commodities. So then there's also, in commodity research people, they have this notion that, well, the Fed has been all this easy, therefore it's going to show up in commodity prices sometime in the future, and particularly gold and silver. But I can't support that, because what you have here is that the boom has been in paper, and when a paper boom, like stocks and bonds, goes bad, it really goes bad. That will not set up a rotation where you could have stocks and bonds going down and commodities soaring. That seems highly unlikely, because you've got a lot of supply out there of commodities. You had 2006 to 2011, where, let's just look at the real price of copper, remained very high. The percent gain in the real price of copper was huge in a 100-year record, and then it stayed up there, so that prompted a big expansion in copper mining capacity, which is plaguing base metal prices today. So it's going to be very interesting. I wouldn't mind getting the story out that the idea that Volcker personally had inflation, it's just so palpably wrong. He just happened to be on duty at the Fed when a massive global bubble in commodities completed and crashed. So,
hey, Bob, it's amazing how the central banks never seem to take credit for when things go bad.
Oh, that's the artistry of central banking, is to look in charge, except for when it's going wrong. And I think the public will eventually discover that as well, that they're a bunch of fraudsters. So this then gets us around to our favorite item, which is gold. And the last technical advice we had on that when it was up towards 1,300, Ross came out with a study saying that it was overbought and could correct back to somewhere between 1,200 and 1,225, where we are now trading. We do not have any technical comment on this one, because when you look at it, Jim, looking at gold in dollar terms really is nothing other than trading or speculating in the currency that you're in. So, if you're looking at gold in the United States, it's in dollars. If you're in Europe, it's in euros, and that's fine. But there is a place for investors in the scheme, investors in gold stocks, and that depends on the earnings power of those gold stocks. And they have their best innings, as we point out, in a post-bubble deflation, because the cost of mining gold in a post-bubble deflation goes down, while the price of the bullion, it can even remain constant. But what we're looking at is the real price, where you divide gold by the producer price index, or by, as we do it with our own commodity index. It's at a very important low in June last year, and it's recovered a long way since. The last few months have been a correction in it, but it looks like it's getting ready to go again. And people now, you look at some mining analysts who are now saying, well, crude oil is a whole lot cheaper now, and energy costs are an important part of mining, and it's getting better. So the education from the markets is starting to get through. So at some point, this is all we can say, is that the gold shares will shake off their blues and get moving up with the real price, because it improves operating profits, and it'll soon be reckoned with. So we like the gold sector, and have been advising people to accumulate some gold stocks on weakness, but we're not yet fully invested. It's going to take a little more on the chart to get us to, say, hey, let's really go on this thing. And on crude oil, as you know, we were a probable low might have been accomplished in January, and you had a good low there. And then if this is an important cyclical bottom for crude oil, it can take a minimum of 2 months to set a bottom. No V bottoms here. So, but then you see if the U.S. economy is beginning to slow, and of course other regions have been weak anyways, then the demand for crude is not going to be so great. So this is consolidating the crash from June until January. But by the time it really is based out later in the year, you could be beginning to look at more of an economic weakening in the U.S. than we're currently seeing. So I can't really get too bullish about crude oil. This is, again, an item for traders. So that wraps it up, I think. You've got some questions?
No, I think that's a great report, Bob.
There we are, Jim.
My guest has been Bob Hoye. Have a great weekend, too.
And you too.
He's the Chief Investment Strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com Radio. Find us on YouTube at Talk Digital Network, and on Twitter, we're at Talk Digital Net. You can forward comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.